Navigating the world of saving and investing can make you feel as if you're being pulled in multiple different directions. At the JSE, we are aware of this, and so we are thrilled to present to you our podcast, the JSE Investor Avenue. Our primary objective with this podcast is to give you the appropriate information to help position your wealth journey for success. Now, in today's episode of the JSE Investor Avenue, we have a phenomenal lady who we know is going to share a lot of really helpful information with us today on unlocking the world of investing. So just taking you into some of the tidbits about her history. She has an MCom in finance, as well as currently studying a PhD in finance as well. She was acting head of investments at the Government Employee Pension Fund. She's currently the CEO of Satrix, and she is deeply passionate about unlocking access to investments for men, women, and children. Welcome, Fikile.
Thank you, Nongnali. I am so excited to be here with you today.
Tell us more about yourself.
Okay, so I have about 20 years of experience in the investments, and my background is really on institutional asset consulting. And before I joined Satrix, I was approached by the GPF to be the investment manager there, so basically to consult to the GPF and only to one client. And I was there for about 6 years, really just setting the strategy for the business, for the pension fund, so to say, by matching the liabilities with the assets of the business, and then developing a strategic asset allocation, and then creating mandates, and then implementing it, and then monitoring and reporting. And I think when I was at the GPF, I really realized that actually what I love about my job and what I like to do is making a difference. And at the GPF, I was making a difference through really managing my mom's pension money, my dad's pension money, my aunts, my uncles, right? And just making sure that that money is protected and is able to grow to meet the liabilities of the pension funds for when they retire. And prior to that as well, in the asset consulting environment, I was doing something similar. And what I liked about that is that I was able to go out to these different companies when I was in asset consulting, and to teach them about the importance of keeping their retirements and investing, and the importance of making sure that they retire comfortably. And so when I was approached at Satrix to spearhead and lead the team and ensure that there's democratization of investments, I was really very excited.
So excited to have you here. So Fikile, a lot of the investments that are currently happening are from businesses. Fewer people actually invest. What do you think are the myths that are actually prohibiting people from investing?
Sure. I'm actually going to read the myths that are hindering people from investing. The first one is I need a large amount to start investing, right? The second one is, oh no, I've left it too late, so I'm not going to start now, right? The third one is, I don't understand the products or the terminology, so I don't know where to start, so I'm not going to start. The other one is, I can't afford a financial advisor. And the other one is, investing is for wealthy people only. And most importantly, the last one is, I don't earn enough to invest. And so I think that's why you're seeing that the savings rate in South Africa is so much lower, right? Like at 5% of GDP, much lower compared to other emerging markets because of these standing myths that are actually not necessarily true.
You know, I've actually heard someone say ETF sounds like a political party when you explain that ETF stands for Exchange Traded Fund. So what would you like to say about those myths in order to burst those myths to people who believe them right now?
So I don't think these myths are necessarily true. And I think that's why I'm here with you today, to try and burst those myths and hopefully make an impact and influence someone to actually start investing. And there's so many benefits to investing, creating wealth, investing for a certain goal, et cetera, which I hope to unpack with you later on.
Absolutely. So just on that point of needing large amounts of money, what is the little amount of money that I would need to invest let's say via Satrix?
So, I mean, at Satrix, you can invest as little as R1.
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 A packet of chips,
A packet of
or
chips.
investing.
Investing.
Forfeit your chips, everybody.
You can invest as little as R1. But I mean, you know, to be realistic and for you to start seeing a real difference, maybe even 10 rands, for example, or 20 rands. So Satrix now is a platform that is based on fractionalization, where you can invest as little as R1 to buy an ETF. Not necessarily a political party, but an exchange-traded fund.
Yes, and hopefully you'll explain what an exchange-traded fund is to us later.
Yeah.
So over and above that, not many people are investing. We're finding that when it comes to gender analysis, men actually invest disproportionately more than women, despite a household census being done that indicates that about half of our headed households are being headed by women. What are your thoughts about that?
Yeah, so we did a lot of research around that with Maya French Fisher. And what came out there was that women, you know, there's a role-based challenges as well, right? Where women tend to focus more on the day-to-day stuff within the household, such as
my groceries.
Yes, my groceries, buying dishes, petrol, right? Or paying for a school activity, or when your child has lost his school shoes.
Yes, junior socks.
Exactly, socks, etc., etc. And we think that when that happens, obviously you need available money that's available and liquidity. And so that means that you actually don't focus on saving, on investing in the long term. Oh, by the way, also just to add that while men focus more on the long-term fixed payments, such as paying the bond and paying for cars. And so that is more structured. And so you're able to know, okay, this is how much is left in my pocket, and so I will invest it. Whilst with women, it goes up and down. You can't control when the kids are going to lose their socks.
And they outgrow their clothes.
Exactly.
Yes.
And so you need that money and you need that liquidity to pay for whatever happens in the short term and whatever expenses you may need. And so that means that you actually then are less likely to invest, but to start saving. The other issue is, the imposter syndrome, where women tend to think that actually they don't know much about investments.
It's too hard.
It's too hard. And while men on the other side think they can invest. And so, exactly, I'm just going to put in the money, man, I'll wing it, I'll learn. And so, but women want to get the facts straight and the facts right. And they probably undermine the ability to start investing.
We get stuck in analysis paralysis.
Exactly.
And we don't invest.
Yeah.
Now, what is that impact to a woman's headed household? Because there's men-headed households where, there is that focus, and in some women's headed household, then that focus on investing isn't there. What are the consequences of that, given that half the population is in a woman-headed household?
Absolutely. It's a low savings rate that you see as well, so you've got a good point. And the other one is actually not being able to invest and having that missed opportunity to grow your investment, because we know that investments require time. So you have to invest over the long term. What I always say in my talks is that have two kitties. One small kitty for savings, where you keep savings for a rainy day, and have another kitty for investing. And so that in that way you're able to know, okay, I've separated the two, and the investing is going to be for a long term, and my savings are going to be for that rainy day or for when I need a little extra to solve whatever issues I may have in the short term.
That's great advice, Fikile. So often we find people confuse saving and investing and trading. And if you double click, someone will say, I invest. And then you say, what do you invest in? And you find out it's actually a savings account. But could you differentiate for us, what is the difference between saving and investing and trading?
Yeah. So the thread there, the common thread that runs through all three of these terminologies is time, risk, and return, right? If I look at investing, for me, investing is putting money that you might need in the short term. So that covers the time. And so when you put that money in the short term, you want to make sure you put it in a less risky or less volatile product or instrument. And investing is putting money away for a long-term goal. And so when you invest for a long term, over a longer time, you are able to stomach the volatility of that investment, so the bounciness of that investment. And then trading, on the other hand, is also about really growing your money, right? Wanting to take advantage of different opportunities in the market, but in the short term. So you take advantage of that volatility that you get in the market.
Thank you so much for explaining that to us. So now take us through the mindset of an investor. What are the things that I need to think of from a mind money behavior point of view?
So I think it's very important for you, and I speak for myself because I'm really passionate about that, but from a mindset perspective, you need to make sure that you align your goals with your investment. So for example, and I think this is one flaw that people actually experience when it comes to investing, and they get bitten and then they don't come back. So it's important that you make sure that you align your goals with your investments. So for example, if I need money in the next year, say I'm saving for a wedding or whatever, I need to make sure that I invested in a product that is aligned to my goal. So I can't invest it in a more volatile product, like investing it in equities, for example, but maybe money market or fixed income where I'm guaranteed, or not guaranteed, but I have a view and a sense that I will get what I invested in the product.
So I love the fact that you had spoken about goals, because I have found that South Africans have a very clear behavior around certain goals. So I want to have money in December. I'm a Goduka. I'm going to my home province of Limpopo or Eastern Cape. And so I have a stokvel account and we save for 11 months. And on Black Friday, the money gets taken out and it goes home, right? So we have that a lot for savings. And we may also have for a funeral. So we know that we are going to leave this planet, and then we have different products for that. So we, Masngcwabisane are very, very popular because we know that that is a milestone that we'll achieve. Take us through goal-based investing. What is that, and how can I use that?
Yeah, so I mean, I wanted to just add there, you've got a good point on stokvels. I view stokvels as saving because, you know, of the short-term nature of it, right? You put money away for something specific, 11 months, and then you're done. And then you start again. Right? So goal-based investing is basically aligning your goal with your investments. But you need to make sure that your goals are smart, right? They have to be specific, measurable, achievable, reliable, and time-based. So it's very important that when you do set those goals, you're able to tick these measurements, right? For example, a goal can be saving for a deposit for a bond. I like to say my goal is saving for creating wealth, right? So my goal, saving for a bond, could be perhaps maybe slightly shorter than creating wealth, depending on how much I put into my investment account. Yeah.
I love that example because it's one that everyone can relate to. So if I had to use that example, I would say, I want to buy an X million rand house by a particular year. And then I circle back and say, okay, what is the time base of that bond? How much can I afford to pay per month? I would look at the rates and taxes of the neighborhood that I wish to look at. And then I would say, okay, based on the affordability, and this is now the goal, what is the right thing for me to do in order for me to be able to achieve that goal? And what are the right types of investment products that I could look to that would accelerate the rate at which I would achieve that goal?
Definitely. And the other one is what is the return required, right? We know that for equities, you're more or less likely to get about 10% returns per annum. And so what you can apply for, as an example, is Rule 72. So Rule 72, you take 72, you divide it by the assumed return that you want or that you think you're going to get for a specific product. So for equities, we say 10. And so that's going to give, for you to double your money, according to Rule 72, you would need to invest that money for 7.2 years. So that really helps you and gives you a guideline, if you want to start somewhere.
Okay, so now let's say I'm interested. I've got the vision, I've got it as a goal, I've got SMART. I don't know where to begin. How do I begin?
Yeah, so that's a very good question, Nongali. So I think you can do a lot of research with or without a financial advisor. Some people call it DIY investing, where you can invest in different asset classes, and we determine the asset classes for you. And my favorite, the top 40, or you can invest in offshore equities, which is the MSCI. And so, it's easier because we've given you that access range. You pick one based on your goals, and you can choose to invest in ETFs or a unit trust as well.
So take me through, what is the difference between an ETF and a unit trust?
Really, it's just a vehicle for you that you can use towards investing. An ETF is really just a basket of different instruments. In this case, your instruments can be stocks. And the main difference there is the trading. So with ETFs, it continues to trade on an intraday basis. On the Johannesburg Stock Exchange. And then with a unit trust, it trades once a day and is basically trading through the unit trust MANCO or management committee.
So maybe let me know if I've understood this correctly. An ETF stands for an exchange traded fund, and it's like going to a grocery store and buying multiple pieces of food, let's say. Yeah. And a share is one piece of food, right? And then a unit trust is the price changes at the end of the day versus an exchange traded fund, which is for ETFs, where you have the groceries and that actually fluctuates during the day.
Yeah, that's basically true. And to make it even more specific, you can, when you buy your groceries in an ETF, you can buy 10 apples or 40 apples versus buying one apple, which is a stock, for example. And that's a top 40 ETF, so a number of apples, right? And then with a balanced ETF, you can get red apples, bananas, and green apples and grapes. So it's different asset classes or different fruit.
And then SA top 40 it's the stars, it's staring. It's
exactly
the highest performing groceries in an exchange traded fund.
Absolutely.
And then balanced, you have different mixtures based on certain rates of return. And that's so much better. Well, that's such a nice way to actually start investing, because then a lot of people don't know how to start. Should I pick this stock? Should I pick apples? Should I pick granny apples or red apples? Should I pick, I don't know where to start. And so when you say actually have a basket, get the whole fruit, it's really great.
Absolutely. And I think from a diversification perspective, that really helps you, because should one company, get liquidated, say it's about exposure, right? If I take my 10,000 rands that I've worked so hard and I put it in one company, Steinhoff, for example, and that gets liquidated, I've lost all of my money. But if I take my 10,000 and I invest it in this basket of shares, should one company get liquidated, I still have exposure to all the other companies, which is great from a diversification perspective. Yeah.
So let's say I'm a member of a stokvel and my stokvel's primary focus is on saving. How can we as a stokvel invest?
Yeah, that's a good question, Nongali, because when I started in the investment industry about 20 years ago, my friends and I, we started what we call an investment club. And in the investment club, we would meet. So we would recommend an exchange-traded fund. and we would meet every once in a while, as a bunch of girls, to talk about the different ETFs that we've recommended. And I think that helped us a lot. I think the fact that I was in the investment industry helped me and my other friends who were outside of or contributed towards me helping, or the ladies in the investment industry contributed towards us helping our friends outside of the investment industry, because then they were able to be exposed to the different ETFs and also then to start discussing them over a glass of wine or whatever you fancy, and to invest. And I'm proud to say that I still have that kitty investment, and I've kept it.
Halala.
Yeah.
You've actually triggered a follow-up question to that, to say, how do we start having these conversations freely and openly? There's a particular perception that men tend to have these conversations very openly, but women and certain other spaces don't often have these discussions about finances, investments, and sharing that information so openly. Why do you think that is the case?
Yeah, I think it's the lack of focus on it, right? I think you and I spoke about saving versus investing, So I think if I just put my money in a money market or in a cash in my bank, then I'm fine, So I think the important thing is to start talking about investments, start thinking over the long term. What do I want to do? And you can be intentional about it, or you can be unintentional about it, right? So intentionally, you can set up maybe a meeting once a month to discuss investments. And if you still want to learn, you can invite a financial advisor, to come and talk to you about the different investments. So I think it's about being really intentional. And it's not only about talking to your friends about it, but also discussing it on a dinner table with your kids, right?
Absolutely.
And introducing them to investing as well. I mean, I have a thing that I do where if my kids do something, I pay them and I say, this is the money I'm giving you, but I'm going to put it in your investment account. And so they can start learning and seeing that power of compound interest.
I love that so much. I was that child. My father's a retired financial advisor, so we spoke very freely about these things, and it does make a difference.
Absolutely. The other one is, we know that the consumer is in a very tight spot at the moment. Markets are tough, but some stats that, the unemployment rate has increased. So we understand that interest rates are high, the consumer is squeezed, inflation is high, but it's slightly coming down, the oil price is high, and so it's important for you to start, right? Even if it's small, and you can increase that amount over the long term.
I think it's really key nuggets that you've shared, that if you can afford airtime, you can actually afford to participate in the investment journey.
Absolutely.
So now I'm interested. Now I know that I can invest with as little as R1. So I forfeited the chips that I was going to buy, every day. I've got that R1 or R10. And now, take me through, what kind of books should I be looking at? I'm really curious and I'd love to know more. Where can I get more information?
Yeah. So I think my favorite book would be, my favorite book is The Little Book of Common Sense Investing, and this is by John C. Bogle, and it really just focuses on indexation and creating wealth for yourself, and using indexation vehicles to create wealth for yourself. Or if you want to take it really to a really basic level, and you talk about budgeting and changing mindset. My favorite one is The Richest Man in Babylon. A very old book, but I think it always does the trick. Yeah.
What's indexation?
Indexation is really about tracking a certain index. So for example, an index is the performance of different underlying instruments, such as stocks.
Perfect. What are your 5 key takeaways that you'd like to share?
Okay, so my 5 key takeaways is start early. It's never too late to start, even if it's with as little as R1, even if you don't have, you're not 100% sure in terms of the risk return profile, etc., you'll figure it out. And I think what we found was that once you get in there, you know, you're able to read more, learn more.
Start.
You know, once you've started, you're able to grasp more knowledge. Why? Because now your money is in there, right?
Yes.
The second one is have a goal. So it's important for you to have a goal. The third one is be patient, you know, because you're investing over the long term. And also it's important because then that power of compound interest comes in, where you earn interest on top of the interest and then interest on top of the interest, and your money continues to grow. And I think the other one is understand your risk, your risk appetite, you know. Are you able to stomach it when the market is not doing well? Because the market is not always going to be doing well. And the last one is good luck.
Yes.
You can do it.
Thank you so much, Fikile. I think there's so much nuggets that you've actually shared with us today. And I'm sure people are going to leave this being ready to invest, being ready to lean in more and feeling empowered with the information that you've shared.
Thank you so much,
Thank you.
Nomali.